Now, I don't know why the non-farm payroll reports constantly have to be revised to the downside, but you can, imagine maybe it looks good for certain people to purport that X number of jobs were created. And then, when they do the revisions, who really looks at the revisions? It's the headline. It's the headlines like, much better than expected that they're really going for. Now, let's just look underneath the report other than just the revisions. Government hiring accounted for 52,000 people. That's a tremendous amount of unproductive people being hired.
The Financial Survival Network. Now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. It's 1/5/24. Happy New Year to all. We've been a little bit slow lately, taking it easy, family visiting from out of town, and just saving things up. So we're starting off the year right with our good friend, Michael Pento, pentoport.com. And hey, Michael, great news today. Non-farm payroll report stronger than experts expected. I don't know who those experts were. I don't know what they've been smoking. I have no idea what they did for the past, 4 New Years. But I guess whatever it was they ingested is carrying out for a week now.
Happy New Year to you, Kerry, and I wish you the best of luck, prosperity, and health for 2024. Let's just start with the CNBC headline. The non-farm payroll report was much better than expected. Much better than expected. You go and look on CNBC's website today. That's what you'll find. So the number came in at 216,000 versus the 175,000 net new hired estimate. Now, what they don't really, let's just say obfuscated, or they left out of the headline was the revisions were negative 71,000 for October and November. And you add those 2 months together, there was a 71,000 person revision to the downside. Now, I don't know why the non-farm payroll reports constantly have to be revised to the downside, but you can, imagine maybe it looks good for certain people to purport that X number of jobs were created. And then, when they do the revisions, who really looks at the revisions? It's the headline. It's the headlines like, much better than expected that they're really going for. Now, let's just look underneath the report other than just the revisions. Government hiring accounted for 52,000 people. That's a tremendous amount of unproductive people being hired.
Right. Worse than unproductive. A lot of the times they're like destructive of productive people, right?
Of course. So what they do is they tax the productive part of the economy, and then they employ people to what I call productivity killers is what they really are. Mm-hmm. Now, let's go deeper into that. There was a 676,000 person decline in the labor force. And if you look at, there's 2 surveys. So there's the establishment survey and the household survey. As you know, the establishment survey showed it was much better than expected. But the household survey showed there were 683,000 fewer people employed from December to November. I said that right. 683,000 fewer people. The average work week fell. The index of aggregate hours work dropped as well. And then we look at the ISM, Institute for Supply Management's manufacturing and service sector survey. Very key, very, very predominant measures of how the economy is really doing. Both those surveys showed that there was a decline in hiring. In other words, a net shedding of jobs in both the household, and the manufacturing and the service sector. So if you look through that better than expected BS, that donkey dung that they like to and concentrate on, the jobs market is deteriorating, and it's deteriorating quickly.
Mm-hmm. So
those are the facts. Those are the facts.
Things are not always what they seem to be, are they, Michael?
No, not at all. Not the way the mainstream financial media and Wall Street purports them to be. Don't forget, if you look at CNBC and every other major financial media outlet, not yours, not the I call the alternative financial media, that we get real facts and real analysis. They're paid by their advertisers, and those advertisers are who? The major Wall Street banks.
And big pharma,
So,
right? Big
yeah,
pharma and the banks, and not many others left.
yeah, yes. So if your major sponsors are the ones that are trying to peddle stocks, IPOs, corporate bonds, then they get paid to pervade this myth of a perpetual bull market and that you always should be invested no matter what you do. And they tend to ignore the big, pullbacks in the market like 2000, 2008, 2018,
Well, they're minor
2019,
blips.
2020, 2022.
Minor blips.
Kerry, if you're preparing for retirement, what's the one thing you worked hard your whole life? You saved a few $1 million or maybe more or less in some cases. And you say to yourself, what's the number one thing I can't have happen? I can't have another 30, 40, 50, or 80% decline in the stock market. That's the number one thing you should be thinking about. Warren Buffett said it best. Just don't lose money. Just don't lose money. And here's the thing. The construct of the economy and the markets are so artificial. It's absolutely susceptible to these massive air pockets in valuation and prices.
Sure. Hey, when we last spoke, you said basically the bond market was broken, wasn't functioning properly, and that that bad things were going to happen here. Can you just follow up on that? As far as a lot of people wanted to know, how is the bond market broken? What is it not doing, or that it should be, or doing that it shouldn't be?
Well, what it shouldn't be doing, Kerry, is trading like a NASDAQ small cap pink sheet stock that goes up and down, 30% a day. The bond market is trading like a very illiquid pink sheet stock on some days. I mean, you see even today, we had the announcement of the better than expected jobs report, and yields shot up, way above 4% on the benchmark treasury. And then the ISM services sector data came out and yields plunged to a huge drop. And now they're back up again as of the recording of this interview. This is just on Friday of the non-farm payroll announcement. So there's a lot of illiquidity in the bond market. That's why it's broken. I mean, it's broken because dealers have a lot of regulations now. They can't keep a lot of inventory. You got, Basel III. It's broken because of the Fed's reverse repo facility, which is running dry. It used to be $2.5 trillion. Now it's only $700 billion. So when that easy liquidity, the bond market is already illiquid. When the reverse repo facility goes to 200 billion or around that number, that's when the easy liquidity is gone from banks to buy bonds. And then you're just stuck with the Treasury has a $34 trillion debt. Annual deficits are $2 trillion. They have to roll over $5 trillion because, bonds mature. You got to roll them over to somebody. So the Treasury has to refinance $7 trillion in 2024. And who the hell is going to buy it? If the Fed's selling too. The Fed is still in the midst of quantitative tightening. And that doesn't really bite because it's being offset by the reverse repo facility. That's money that's parked at the Federal Reserve. Banks are parking their reserves at the central bank. Right. But now the central bank says, okay, yields are probably going to go down. They're saying that they're going to lower interest rates. So people are taking money from the reverse repo facility and buying bonds. So that's offsetting QT. But in March, that goes away. So QT is really going to start to sharply bite into whatever liquidity is left in the bond market. So you'll see the bond market trade even more erratically than it already is.
Even more, huh? So where is that going to leave us here? Like, you've been pretty spot on about calling what the Fed was going to do. Supposedly everyone's celebrating. There's a pivot going on. Obviously, rates have fallen dramatically over the past month. Is the pivot real or is it fake?
Well, the Wall Street. So I believe that Wall Street takes a pivot, a whiff in the air of a pivot and then runs with it. So the Fed said that they weren't going to discuss rate cuts They said it, Powell said it about 3 weeks before this last Fed meeting. And then it turns out that was a complete lie, because the dot plot shows that they not only discussed it, they have 3 rate cuts in the dot plot for 2024. Wall Street took those 3 rate hikes and doubled it and said it's going to be 6. Did I say hikes? 3 rate cuts.
Rate cuts, yes.
Rate cuts. Wall Street took that and ran and doubled it, and now it's 6 rate cuts that are going to be supposedly taken in 2024. And then you see, better than expected non-farm payroll report. The unemployment rate stays the same. Employee compensation was increased. Employee cost index rose. So now they're saying, okay, there's not going to be 6. Maybe there'll just be 3. But the pivot is all a rumor right now. I mean, the Fed is not right now cutting interest rates, and they are still doing QT. And as I said, in March is a key month, Kerry, for investors and the economy, the market. It's just huge. Not only does the reverse repo facility run dry around that time, but the bank term funding program, that facility is supposed to expire in March. That facility,
you believe it?
No, I don't. I really don't, because see, Powell bailed out the entire regional banking system in this country.
Right.
In March of 2024. He printed this is a fact. He printed $400 billion in 2 weeks. Kerry, just so you know, from 1913, the formation of this horrific organization, until 2007, the Fed's balance sheet was $700 billion, around $750 billion.
Right.
They printed, so it took all those years to get to an balance sheet of $750 billion. And it took 2 weeks to double that size. 2 weeks. 2 weeks.
It's insane.
2 weeks, Kerry, 2 weeks. Come on, man. They should be shocked at that. All right. 2 weeks to double it, that size. And they bailed out the entire banking system with that. And there's still $133 billion of banks. So this is what they did. Banks said, banks are failing left and right. There was 4 banks that failed in March. The regional banking system plunged in value, the KRE, you can look it up. And they did it because their assets, mortgage-backed securities and bonds, were way underwater because of what the Fed did, had to catch up to hiking interest rates. And nobody wanted to hold a mortgage bond that was yielding 3% when mortgages were yielding 8%. And no one wanted to own a treasury that was yielding 0.5% when they can get 5% on a T-bill. So these banks were insolvent. They were going bankrupt left and right. So Powell says, I will take your assets at 100 cents on the dollar, and I will take them off your balance sheet for 1 year. And then, and this is March. March is coming very quickly, Kerry. March, you're supposed to give me back. I'm going to be handing you your assets that are still severely underwater, and in some cases much more severely underwater than they were in March of 23. And you're going to give me back 100 cents on the dollar, all that credit plus interest. Now, if that happens, you're going to see the flushing sound of the stock market down the toilet. Now, some people say that he has to do this because he has to stop the speculation and he'll never get to 2% inflation. I happen to think, and it's hard to read this schizophrenic, feckless, and sometimes mendacious Fed. It's hard to read what they're going to do, but I believe he has to err on the side of inflation. So he's going to expand and extend.
Okay. We agree on that. So what is that going to do to our inflation rate? I mean, let's assume that right now, and I'm not buying it, but inflation's totally under control. Prices are stable. They're not going any higher for right now. But now the Fed's gonna step on the gas pedal and ease up off the brake pedal all at once. What does that do to our inflation here?
Well, you asked the most salient question that there possibly is. Good for you. So prices for most Americans, 60% of Americans have virtually no savings. They're living paycheck to paycheck, unfortunately, Kerry. Those are the people that can't afford groceries any longer. Those are the people that are ringing up massive credit card debt so they can make ends meet. For those people, prices aren't coming down like they have to. Prices are going up more slowly than they were.
Right.
So they're going up at 3.5, 3.7% year over year, which is still tremendous salt on a wound, because they were going up 20%, officially 9%, but in reality 20% post-COVID for a few years. And now they're only going up, they're going up more slowly from an already unaffordable level. So you ask the great question, what if Powell was to, what I think he's going to do, stop QT, and maybe even go back into QE, extend the bank term funding program, and cut interest rates. He's going to be doing that when inflation is already wiping out and eviscerating the middle class. And when inflation, record high inflation in this country, is still fresh in the minds, that sting of record high inflation is still very salient in the minds of Americans. So what that means, I think, inflation has the risk of running intractable at that point. If he's gonna stop the bank term, stop the quantitative tightening, extend the bank term funding program, cut interest rates to try to boost Wall Street and keep big banks in a solvent condition, and stop the debt inflation and keep asset bubbles boiling on the boil, then he risks obliterating the confidence, whatever's left in the US dollar and in our treasury market. And that could have deadly ramifications, because if you have a slowing economy, a stagflating economy, one that's marked by a stagnant growth and very high prices, and you go back into those, do those things I just mentioned, you risk having long-term interest rates rise instead of fall. Now, normally when the Fed, when you see a recession, that's the cathartic effect of the market at work. So you see debt defaults, asset bubbles pop, interest rates plunge, and that begins that's the beginning of the healing process. But the healing process can't take place if the bond market goes ballistic and people lose confidence in the purchasing power of the dollar and US treasuries. You can see yields skyrocket, and then there is no salve. There is no healing process. It's just a massive debacle where you see a bear market in treasuries, prices go down, yield goes up, and stocks go tumble.
Wow.
And that could happen. That's not a fat tail risk. That's very probable, because you haven't cured the problem. You're gonna resort to the same playbook that you have since 1987, which was, hey, there's a hiccup in the economy, there's a blip in the stock market, we're gonna print money, we're gonna monetize debt. That works in deflation and disinflation. It does not work in inflation.
It's interesting, Michael, you and I remember the last inflationary cycle in the 60s, 70s, and 80s. But most people alive today don't know anything about it. They don't remember it. They weren't alive then. And basically, they believe whatever BS the Federal Reserve dishes out to them. That I find kind of shocking.
Kerry, most people don't even remember, or alive, or at least alive to a point where they're actually managing money, when the Fed wasn't able to just ride to the rescue. I mean, think back. I just mentioned in history. What happened in 2000? What happened? Let's go back even further. In the '87 crash. How about when the Thai baht collapsed and the Russian debt default? How about when the NASDAQ collapsed? How about in 2008, the real estate crisis? How about when we had an outbreak or before that, with the repo crisis of 2018? How about the COVID outbreak? How about the 2022? Everything is met with the same, every crisis is met with the same prescription. We're going to cut interest rates, and we're going to print a lot of money and monetize a lot of debt. Now in post-COVID they've unleashed the helicopter money squadron, where you just, people get checks in the mail, and instead of borrowing the money from the private sector, the central bank just prints it.
Yeah, this is true.
We've crossed the Rubicon on this. This is the shark has been jumped. You could use any kind of metaphor you like. But if they try that donkey dung again, if they try that BS again, they'll fool nobody. Powell can't come back and say, we're really behind on the inflation ball and we're going to tighten interest rates. No, you're not, because what you really are in place to do, Mr. Powell, and this has been the case since, for decades, the central bank was created to protect banks. They are the bankers' bank. And when banks get in trouble, they go to the Federal Reserve. And a little small consequence to that is that the purchasing power of the middle class and the US dollar is wiped out. I'm not just talking about against the euro. I'm talking about the purchasing power of the dollar against gold, the actual value of the dollar. Look, gold used to be $33 an ounce. It's $2,000 now. It didn't happen because gold, it became more valuable. It's because the dollar lost its value. It's the yardstick in which you measure the purchasing power of your currency, and it's crap. It's crap. The currency is crap.
That she is. All right. So now the question is, what do you do about it? How do you protect yourself? How do you hide from this onslaught? Can you? Is there anything you can possibly do?
Well, we have 70% of our portfolio in short duration treasuries, the shortest duration that you can find outside of T-bills. So I think in particular, the next big thing, the next shoe to drop is going to be the manifestation of recessionary data. You're going to see some really bad economic data, which of course is going to cause the Pavlovian response of people rushing into the bond market. That's why we're at 1 to 3 year treasuries right now. We left the safety of T-bills, which cannot participate in duration, an increase in a recessionary environment, because there's no duration there. There's no convexity. So I went out a little further. I do own gold. I do own some miners. I don't have any direct shorts other than high yield right now. High yield is definitely a short. That remains a short for me. I think the next step will be this manifestation of the recessionary data. You'll see the Fed react to that. It'll be too little, too late. You'll have a recession. Depends on how much they do. I mean, there's a range of outcomes here. I mean, what if Powell and Yellen, the head of the Treasury, once again combine forces to say, hey, this is what they did. Let's just launch a helicopter money squadron of $6 trillion of checks into the mail.
Yeah.
And I'll have the Fed monetize $4.5 trillion of it. That's exactly what happened. Kerry, what do you think is going to happen to the deficit? We have a peacetime deficit. I get the vomit in my mouth. The agita is coming as I speak. We have a $2 trillion annual deficit in peacetime and supposedly Goldilocks prosperity. That deficit is going to go to $6 trillion if we have a recession. That's what I think. That's my prediction. So who the heck is going to buy it, and at what price? That's the checkmate. People tell me all the time, this aggravates me. A couple of things, many things aggravate me, but two of the things that aggravate me is that, well, don't you know the reason why we had such great growth is because the Fed and Treasury, particularly the Treasury, they ran these huge deficits, and deficits are very stimulative. Now, what deficits do in the long run. They may in the short term boost, maybe, but what they do in the long run is they create a condition of stagflation, and so they are productivity killers and inflation engenderers. That's what they do. That's what deficits do in the long run.
Yeah, exactly.
So if they do it now, if they go to the usual playbook, watch what happens in long duration bond yields, 10 years, 20 years, 30 years, zero coupon bonds. If those yields rise instead of fall, look out below.
Yep. So they'll actually, we already see that when they just print money now, it doesn't really grow the economy any, right? No. The economy doesn't grow from it.
No, exactly. You're exactly correct.
And then if we see when they cut rates actually go up. Well, what is that going to say?
well, you'll finally get the re-steepening of the yield curve, but it's not the kind that you like. I mean, usually, usually what you want to see is bond yields on the short end fall because they're following the Fed. That's going to happen. But long-term yields come down a little bit in response to the recession. But if that yield curve steepens because the confidence in the bond market goes into the crapper, you're going to see, we're going to be in a debt spiral, where they have to keep issuing debt and no one wants to buy it unless interest rates go to the moon. So the Fed prints money to keep interest rates down, which causes more of a debt and deficit. And you just go into this vicious debt spiral in the bond market. That's what that's a very, unfortunately, this is what you get when you have artificial markets. That's a real risk right out there. It's not the base case scenario, but it's a definite risk.
But so the pivot is on, although maybe not on as much as Wall Street was hoping, right? But the pivot's definitely on.
That's going to be the big surprise. What if Powell pivots and the bond market doesn't respond in the Pavlovian response, that the reflexive response as always? So keep an eye out for that. It might have. I think it's going to happen initially. You'll see that reflexive reaction into the bond market as the recessionary data manifests. But boy, it's going to be bad news if that doesn't have a protracted nature to it. Watch out for that. But that's the kind of thing I monitor here. I have an inflation, deflation, and economic cycle model. It's a 20-point model, 10 components for inflation and deflation, 10 for recession and growth. And that keeps me on the right side of the trade. Last year I was predicting that we would have a recession, but the model signaled after what Powell did in March that, hey, wait, credit spreads are quiescent, and financial conditions are actually loosening instead of tightening. So that kept me from shorting the market. I'm watching those indicators very assiduously, and I will react accordingly. And that's your early warning sign to what's going to happen in the broader stock market.
All right. So gold, obviously it's had a nice run up, but nowhere near where it should be under all the situation you're talking about here.
Well, gold just reached a record high recently, and it did so under an interest rate regime that went from virtually 0% to 5.25%. That's pretty good. That shows you how much central bank buying there is, how much the supply demand dynamic has gone in favor of gold. I have to wonder what's going to happen when the confidence and this happened, by the way, gold hit an all-time high while the dollar also was surging for the past couple of years. I mean, we were long the dollar before we sold it a few months ago. That was a very good trade for us. So what's going to happen with gold if the confidence in the bond market and the dollar get obliterated? What do you think is going to happen to the price of gold? Oh, boy. I mean, gold follows real interest rates. And if real interest rates are falling, then gold is going to skyrocket. And that very well could be the case.
Okay. All right. All right, Michael, you've given us a lot to chew over here. And hey, I'm sticking with the gold. Silver, we haven't seen that big boost yet in silver, but I think it's inevitable down the road. I don't know. I guess the best thing we can do is check in with you in a couple of months and see what's happening. All right?
I'll look forward to that, Kerry.
All right. Just tell us best place to find you, connect with you on the web.
So the website is pentoport.com, pentoport.com. You'll find a link to the midweek reality check. So I record that every Wednesday evening. It gives me gives my audience the salient and important and real takeaway from data that you don't see on the carousel of fools on the mainstream financial media. It's $50. It's just $50 a year if you like the free trial that ends in 5 weeks. And if you are a U.S. citizen, you have $100,000 to invest. I'll invest the money for you in the IDEC portfolio directly. All
right. Well, hey, the link to Michael's site is in the show notes to this interview on financialsurvivalnetwork.com. If you got a question for Michael and myself, kl@kerrylutz.com is the email address to use. And when you're on the site, sign up for the free newsletter. You'll find it really helpful. We got thought leaders like Michael and everybody else here. And Michael, in anticipation of the Powell pivot, we're starting a new site called the Inflation Cafe. It's inflation.cafe, because I was at a undisclosed cafe recently that we all know and hate, and they gave me half a cup of latte, and it was
And
double
charge you
what it
full price.
was a few years ago. And I said, you guys don't sell coffee. You're in the inflation business. And thus was hatched the Inflation Cafe.
Well, even air has become more expensive.
Yeah.
I'll leave you with this one thought. What consumers need desperately, and if Powell had any integrity, he would say, I need to get prices down to where they were. I need to get home prices down so that first-time home buyers can buy them. I don't need to talk about reflating asset bubbles and an economy when inflation is rising at 50% or more above his asinine 2% target.
Yeah, exactly. Could not agree more. All right, Michael, thanks for stopping by. We will talk to you in a month or two. Let's see how this pivot unfolds.
Looking forward to it. Take care, Kerry. Bye-bye.